4:30. Okay? Good afternoon here in the Zurich airport. Good evening, good morning on the call. And very welcome to the full year 2025 Avolta results presentation. I'm Xavier Rossinyol, the CEO, and I'm joined here with our CFO, Yves Gerster. Let me start straight on the highlights of 2025. We have reported an organic growth of 5.5%. Very strong organic growth in 3 of our 4 regions, 8.2 in EMEA, 7.4 in Latin America, and 6.9 in Asia Pacific. The only region that has not been growing so strongly is the US, with a flattish growth. So if you take the group without North America, the organic growth would have been 7.9%. We have once more increased the EBITDA margin from 9.4 last year to 9.7 in 2025. And that's the 4th year in a row where we increased the EBITDA margin. In 2022 was 8.8%. Equity free cash flow has reached 487 million. This is a 15% increase between 25 and 24, with a massive improvement on the cash flow conversion, from 33.5 to 36.8, clearly ahead of our own expectations. Equity free cash flow per share has increased an 18%, also supported by the reduction of the number of shares through the share buyback. Earnings per share, a fantastic 33%. This is a combination of a strong EBITDA and good performance in all the other lines of the P&L, plus the consequences of the reduction of number of shares. Leverage, very important for us, has again reduced from 2.1 times net debt to EBITDA to 1.96, crossing for first time in many, many years the barrier of 2 times. And that is including all the payments we have done on dividend and all the money we have invested in the share buybacks. Return on invested capital increased again from 9.5 in 24 to 11.4 in 25. We've been, for the last 4 years, on a ROIC ahead of the ROIC we had as a company before the pandemic. And Yves will elaborate on how important it is for us to focus on the return on everything we do. But not only a good performance for 2025, but a performance also with a very strict discipline on our capital allocation. We have invested in the business, as we said, with an increased return on investment. We continue deleveraging, following the different layers of our capital allocation. First, invest in the business, then deleverage, a strong balance sheet, and third, remuneration to the shareholders. We completed the share buyback of 2025 with a cancellation of 3.3% of our capital. The board approved in the last meeting to propose to the General Assembly an increase on the dividend from 1 to 1.15 Swiss francs per share, which is a 15% increase. As you know, our policy is that we will distribute as a dividend a third of our capital, of our cash flow generation. As this one increases year on year, also our dividend. And we are announcing a new share buyback of 225 million for the year 2026. If you put together the share buybacks we did in 24, in 25, and the one we are announcing today, for these 3 years, we'll be roughly cancelling 10% of the shares of the company, clearly focusing on delivering more value per share for our shareholders. What's going on at the beginning of this year? The year started pretty well. January is a bit of a a strange month because we had a very strong 2025 January with almost 10% growth. Also, the Chinese New Year is moving between January and February. February, for me, a better proxy of what we are seeing in the company. It has grown 5.5% organically. And like last quarter of 25, we see encouraging improvements in the US. Still slowly, but clearly a change on the trend of 2025. Remember that the US, North America, is our largest country. Middle East situation. Well, first of all, I'm not sure it's of interest of the investors community, but it's very important for our employees. We have 1,200 team members working in the region. They are all safe. We check daily with all of them. Also, we had not been affected in our shops and restaurants. And to put a little bit of context, Middle East region, directly and indirectly, it's accounting for around 3% of our total turnover. So even if this conflict will last for a few months, which I think most people don't anticipate, the effect we will have in 2025, it will be of limited nature. Also, we have seen year after year that this type of shocks have an effect on where it's happening, but lesser of an effect in the global movement of passengers. If you have to go to Asia because you have a business trip, you will not go through the Middle East now, but you will find an alternative route. People are not canceling their holidays. Maybe they are moving from one location to the other. And that's why, once more, our extensive geographical diversification, it proves as a very strong hedging against this type of risks we are seeing right now. And this performance of 2025 is the direct consequence, a clear strategy with relentless focus on execution. And I know it's a bit repetitive because we've been saying the same thing for the last 4 years, but I want to once more remember. Number one pillar is focus on traveler and consumer. And everything we've been saying over the last 4 years, the combination of food and beverage and retail, more entertainment, more flexible stores, more local products, more advanced pricing, more advanced assortment, hybrids, etc., 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 and the investment on data, loyalty, etc., all that is to keep expanding spend per passenger and gross profit margin. The second pillar is the diversification, both geographically and also on business segment. And that, once more, it's proven a key element of our resilience, both in growth and profitability. The last one is productivity, operational excellence. We focus constantly in how we can improve the things we do. And that's why not only growing in a resilient manner, but we are also expanding margin and cash flow conversion. To give some numbers on the resilience and the diversification, we are in 70 countries with 5,000 points of sales in 1,000 locations, but we are also very well diversified on business line. We almost have a third in duty-free, a third in duty-paid and convenience, and a third in food and beverage, which hedges us not only about potential geopolitical shocks, but also on consumer behavior. And the list on the right is just a reminder that 2025 was not an easy year. We had a bunch of things happening. Now we are all focused on what is happening right now, and we might be forgetting that 25 was a challenging year. We had the first Middle East conflict. We had exchange rates all over the place. We had the tariffs. We had the slowdown in the US passengers. We have still the ongoing lower Chinese passenger consumption, the Ukraine-Russia war that makes a bunch of flights between Europe and Asia more cumbersome. Despite all that, we've been reporting very strong numbers. Again, speaks about the resilience of the company. And one of our key focus is a spend per passenger, because that's where we can add on top of the passenger growth. And we do that with the growth engine we presented in the Capital Markets Day a few months back. The three businesses, duty-free, duty-paid, and food and beverage, both physical spaces, shops and restaurants, but also the digital and data side. And with all that, we focus on improving pricing, assortment, having more flexible stores, more distinctive look and feel with more focus on local, because it sells more, enhancing retail and food and beverage, not only with the hybrids, but also sharing information. And now we have enough time with hybrids to confirm that a food and beverage outlet inside a big duty-free store, for example, drives more footfall into the store. So not only you sell what you're selling on the new F&B outlet, but you're enhancing the sales on the overall store. Entertainment. And on the digital side, I'll come back later a little bit more, but a smart use of data. With all that, we've been increasing for 4 years in a row, 22, 23, 24, and 25, the expenditure per passenger. If you discount the effect of the US, our like-for-like this year has been around, like-for-like, without business development, between 5.5% and 6%. And about 60% of that comes from passengers, and 40% comes from a spend per passenger. And what is interesting on the graphic we are putting here is that you see very different behavior per region and per category. And some of the category analysis will resonate you if you follow some of the mega trends or what's happening with some of these categories. But for me, what is very interesting is that despite all plus and minuses, the overall is plus. Again, also our exposure to different categories, all the kind of brands, from the most luxury ones to the most basic ones, it helps us to adapt to the consumers. And what we're trying to do year on year is to do that adaptation better and faster. And for that, we need data. And data is becoming, year on year, one of the key elements of our long-term strategy. And I want to put 3 ideas here. First idea, we are unique on the size of our data pool. There are about 10 billion passengers, air passengers per year. We have exposure in the locations where we are to about 2.5 billion. And last year we had 682 million tickets of customers. And 16 million of those are Club Avolta. So the first clear idea is that we have access to more data than anybody in the industry, and year on year, we might be becoming even a powerhouse on travel data alone. The second idea, we are creating a data and digital ecosystem, putting together all these sources of information we have. One is a transaction data, the tickets, what is in the ticket. Of course, if it's duty-free, we also have the boarding pass, so we have more data. We use data from the airports. We use our Net Promoter Score to see not only what they buy, but how they feel on the shops and the restaurant service. We have, in those stores where we put smart cameras and smart analytics, we also see what happens on the stores, how people move around. We have, of course, a very detailed data on those members of the Club Avolta, which are the frequent flyers. And we are also using a platform of startups, calling it Avolta Next, which is providing additional ways of looking at data. And what we are doing progressively, and without any doubt advancing, putting all those closer and closer together. So when you have more data than anybody else and a very clear data strategy putting them together, you are moving ahead in a different way. And the third idea is we don't do that for the sake of having more data and that's it. Our target is to monetize that additional and better data we are getting. And for that, advanced data management, AI, is becoming increasingly faster and cheaper to generate value from that increased number of data points. There's a bunch of lists, but a couple of examples. If you understand better the consumer, if you have better data on the products, if you have better data on the way people move, you can start applying, for example, dynamic pricing that we tested in 2025, and we're going to extend progressively in 2026. And we see that if you do it the right way, it's a clear system to increase sales. But also, advanced data can improve the operations. One very complex topic for us, particularly in the duty-free side, because we have global suppliers, is the logistics and the supply chain. If you improve your forecasting system, which is basically data, and better, for example, AI, you can improve your assortment, improving sales, gross profit margin, and potentially decreasing working capital. So we see a tremendous potential. But it's not going to happen overnight, has not happened overnight, and we don't want to happen overnight. We want progressive, realistic improvements in the business for the incoming years. And one element of this new data, digital, and AI strategy is CFO Avolta. We've been talking so much about CFO Avolta that we maybe forgot that CFO Avolta was born only in October 24. So it's a 15-month-old program and has already achieved 16 million users or members, represents 7% of the total sales. An average member of CFO Avolta spends 3 times a non-member. This is for show. There is a transaction every 2 seconds. It has won a bunch of awards in the industry. But for me, what is really important is the amount and quality of data we can extract from that and how we can keep fine-tuning our offering, our services, to those CFO Avolta members. And one way of doing that is with partnerships. And we have a bunch of them here, from airport launches, airlines. And you see, we are starting getting to that point where we can see that if you are a member of CFO Avolta and a member of certain loyalty programs of airlines, you consume more than if you are not having both programs. So better understanding the passengers, better understanding the frequent flyers allows us to more and more do better job as a retailer and as an F&B operator. One data point that is not here. We had last year 1.5 million downloads of our app. And 25% of the new members were actually downloading the app. And that's even more important, because if you have your loyalty program in your wallet, we get a certain amount of face time with you. But if you have the app, it's additional. There is people gaming for free in our app. We learn so much, and we are only at the beginning of what we can do to progressively monetize this CFO Avolta. Because it's one of those win-win-win. The passenger, the loyal member wins because they have special treatments. We win because we sell more, and the airport also wins because they get a percentage of that. And one point I wanted to make here is what we call a smart CapEx. Is to emphasize the idea that everything we do, everything we invest on, is based on a very robust governance and a very strong focus on return on investment. And that includes the business development, that includes the refurbishment of existing shops and restaurants. That includes the investment on data, digital, or the new spaces. And 2025 has been on new spaces a very interesting year. We have entered new countries like Tunisia, Saudi Arabia, Japan. We opened the shops now. In existing countries, we have operated new segments. For example, we won the first duty-free store in mainland China, an historical move. And that was because we have a very clear strategy of focusing on geographical diversification and segment diversification, but we had the team in place to benefit from that. We also opened in 25 the first food and beverage in Latin America, both in Mexico and Brazil. Another very interesting move. We have also won important contracts in North America, like several terminals, food, convenience, and duty-free in JFK in New York. And we also have extended many of the existing contracts. I cannot name all of them because it will take a couple of hours, but I want to mention one because it's the contract here in Zurich, which we extended this week for 10 years with duty-free included, which we are very happy. But all what we do is with a smart focus on the return on investment. I was just checking that now it comes, before I have my final slide, a small video, in case people is getting bored of my speaking. Now we have some more energy into the system. So can we put the video, please? And my last slide. So 25, despite all the turbulence and all the headwinds, was a very good year in all the key metrics of our outlook. And we were very disciplined in getting strictly the capital allocation policy. So we have proven over the last 4 years now consistent delivery and consistently doing what we have said. Now, of course, people is going to ask what happens going forward. And once more, we confirm our midterm outlook for the incoming years, which is organic growth of 5 to 7% per annum, EBITDA margin of 20 to 40 basis point additional, and yes, additional to the 9.7 we reported for the full year 2025, and an increased cash flow conversion of 100 to 150 basis points. We've been doing much better on this metric over the last 4 years, but we think we can keep improving another 100, 150 basis points on the current base. And with that, I hand over to Yves. Thank you very much.
Thank you very much, Xavi, and good morning, good afternoon for everybody who joined online, and good afternoon for everybody who joined here in the room in Zurich to this year's financial result presentation. Let me start directly with the highlight of this year's result, starting with the turnover on the left-hand side of the slide. Turnover came in at 13,720 million Swiss francs. That represents an improvement versus last year organically of 5.5%, or, and that's actually the metric I prefer, at constant exchange rate, 5.9% versus the same year, 2024. Looking at EBITDA, the margin has improved by 0.3%, now reaching 9.7%. This is bang in line with the medium or the midpoint of our guidance, which Xavi just have explained, of 20 to 40 basis points improvement year on year in the midterm. Equity free cash flow, once more, the star of the presentation, came in at 487 million Swiss francs. It's a significant improvement versus the number of the previous year. If we look into the growth first, into the detail of the growth, you will notice on the left-hand side that like-for-like came in at 3.9%. As Xavi has explained at the beginning, that's on one hand side driven or predominantly driven by the slower performance of North America. Net of the North American impact, the group would have grown by around 5.5 to 6% on the like-for-like. If you look at the different regions, as I've just mentioned, growth was significant in EMEA, coming in at more than 8%, at 8.2%, but also at LATAM with 7.4% and APAC with 6.9% improvement versus the previous year. If we go further into the P&L and looking at the detailed evolution here, there are two messages from my side on the P&L above the EBITDA margin. Number one is you will notice that the improvement year on year on the gross profit margin is probably not as high as expected. It's a slight decline. You will also notice that the concession expenses year on year as a percentage of turnover has increased, actually quite substantially. And you will also see that personal expenses and general expenses have decreased. Now, there are two reasons for that. Number one, or actually three. Number one is a mix effect. Because of the slower performance of North America, we see an impact on the gross profit margin, on the concession expenses, and also on the personal and general expenses. And the reason for that is potentially an obvious one. And we have presented it in both Capital Markets Day. North America has a very strong food and beverage business and also a very strong convenience business driven by the big footprint we have in North America, specifically in the US. And as we have explained many, many times, the food and beverage business, while it has a very similar EBITDA margin than the duty-free business, comes in at a completely different cost structure when you look at the gross profit margin, the personal expenses and the concession fee, but then also the general expense line. Food and beverage has, relatively speaking, a higher gross profit margin. And because it's the evolution and the turnover growth was lacking behind the other regions, the improvement in the gross profit margin is not as pronounced as it would have been if North America would have grown as well in line with the rest of the organization. So gross profit margin, because of that, lacking slightly behind, or the improvement lacking also slightly behind. But if you look at it on a region-by-region basis, or if you compare food and beverage with retail in both areas, the gross profit margin has increased, but then on a consolidated basis, it did not. Again, a mix effect. The same applies on the concession fees. Concession fees in food and beverage are significantly longer than in duty-free. So the same thing applies here. Because North America was not growing as much as the rest of the organization, the concession fee, relatively speaking, was increasing. And the same on personal expenses and general expenses. Food and beverage has typically a higher general expense, but because of the lower growth, you see a decline there. Now, there's another element I want to quickly mention on personal expenses and general expenses, which is irrelevant. One element there is the improvement of productivity, simplification of processes, automation, and the further use of artificial intelligence throughout the organization from front office to back office. That also supported the reduction of general expenses and also the reduction of personal expenses. This is point number one. Point number two, that's probably a little bit more complex, but we have started to internalize some of the costs which before were covered by external advisors, by support we got from outside the organization into the organization. So that led to a slight negative effect on personal expense, but an overproportional positive effect on general expenses. Some of the things we did there, for example, is in IT. We are focusing more on having the function there in our shared service center rather than buying external advice. And something similar happens in HR, something similar happens also in the finance organization. So we depend less on external advice, for example, also in the area of tax support. That ultimately led to the improvement of the EBITDA margin by 30 basis points. If we go to the lower part of the P&L, you see a number of effects there. Depreciation and amortization came in line with expectations. If I look at the financial result, this was significantly better than the year before. On one hand side, it's structural improvements, it's well management of the interest expenses, some additional interest income on some cash deposits we had. But then on top of that, also by a good positive FX result. So look, we have a natural hedge in place, as you know. So the FX differences we report are not very material. But nevertheless, for the last 2-3 years, it was slightly negative. This year, slightly positive. And this slightly negative to slightly positive helped us to improve the financial result there as well. Income tax has been reduced further as a percentage of EBT. For me, this result here is a good proxy to what we should see going forward. So somewhere between what we have seen last year and this year, 21.8 to 22.8, I believe is a good area of approximation if you want to model our tax rate going forward. And then when it comes to the net profit, we have generated 645 million Swiss francs. Also, minority interest has slightly decreased as a percentage, now standing at 22.8%. There are two effects I want to quickly mention there. On one hand side, as you know, some of the minorities we have in North America, it's part of the business model there, it's unavoidable. And as a consequence of the slower performance in North America, we are lacking a little bit behind there. This is one element. The other element is a more structural one. Because we are optimizing the organization, because we are more efficient on processes, specifically also on global functions and on global elements which are owned 100% by us, we can expect to see a decrease of that percentage over the medium term. So that's more a structural improvement. The last point quickly here is on the right-hand side. If you look at that table with the performance over the last couple of years, quarter by quarter, there's something which is very interesting to observe. If you go vertically, Q1, 22, 23, 24, 25, you do the same for half year, you do the same for the 9 months and the full year, you see that quarter by quarter, year by year, we have improved in line with what we have mentioned from an outlook perspective. So year on year, for every single quarter, we have improved the EBITDA margin by at least 20 basis points, in some cases closer to the 40 basis points. So in range with our outlook we have provided. Moving on to the bridge of the income statement. We have shown that several times in the past. We then didn't show it for a while. It's always reflected in the annual report. Sometimes we have shown it in the annex of the results presentation. But it's one of those things we got asked during the roadshows by investors and external stakeholders to show, because it helps to understand the bridge from IFRS to core. You see it here in a very transparent way. I will not go into the details, but we do actually 3 adjustments to IFRS. One is the acquisition-related amortization, because we believe that especially now in a situation where the big transactions and the big acquisitions lie in the past of the organization, it's important to correct for that, because the concession rights are only activated when it comes to acquisitions. When we grow organically, we don't activate those concessions. And as a consequence, over time, this amount is fading and being reduced. And it would be wrong not to adjust for that, also because core, on one hand side, it should be transparent, but also management compensation depends on that. And it would be wrong to have an improvement over time purely mechanically because of the acquisition-related amortization. The second one, which is much more important, is the lease adjustment. It's related to IFRS 16, and it's purely related to that. We, as you know, believe that IFRS 16 does not represent us properly, and therefore we adjust to that. Something similar applies for the fuel. What is important here, you may like or don't like core. We believe it's the right way to represent our business, but maybe you prefer IFRS. So what is important to note here is the bottom line. The IFRS result, profit to equity holders of 199 million Swiss francs, is by far the best result the group has ever generated, disregarding before or after IFRS 16. If you believe that the IFRS 16 adjustment of 177 million is justified, and you add that to the IFRS 16 result, the bottom line result is about 3 times the best one the group had in the past before IFRS 16. So a significant step up in the bottom line result in that regard. Moving on to the cash flow. It's a record equity free cash flow, but then if you look at the details, it's quite uneventful. Core EBITDA was one of the biggest contributors to ultimately lead to the strong equity free cash flow. On top of that, we had some improvement in the net working capital of 60 million. The improvement in the net working capital is predominantly generated by improvements in inventory. So we are more efficient of managing our inventory, and as a consequence, we're able to take out some of the net working capital there. Otherwise, CapEx is in line with expectations, so is dividend to minorities income tax, and also the interest result. So nothing surprising there. And below the equity free cash flow, we have the three typical lines. You will see the 175 million of share buyback. As you know, the share buyback of last year in total was 200 million, so we have cancelled shares in the value of 200 million. The amount we purchased is slightly less because we still had some treasury shares on stock, and we used 25 million of treasury shares to be cancelled to complete the 200 million program. On top of that, you see the reflected dividend increase there from 100 million the year before, 140 million last year, so an improvement of 42% year on year. And still disregarding the share buyback, disregarding the increase in dividend, we were able to reduce the net debt by around 130 million, standing now at 2.5 billion Swiss francs. And that leads us to the leverage. Leverage is standing at 1.96 times by the end of 2025, which is exactly in line with the medium-term guidance of 1.5 to 2 times. So it's just scratching at the upper end of our medium-term target when it comes to leverage. On the maturity profile, is still very well balanced in regarding to different currencies, different products, different maturities, and also from a fixed and floating mix, with having 80% or around 80% of our debt being under fixed rate arrangements. Now, there are 2 maturities coming up. One is actually in about 2 weeks' time, on the 23rd of March this year, which is a 500 million Swiss franc convertible. We are not going to refinance that. We are repaying that convertible on one hand side with cash, which we had from a refinancing of last year. Last year, we refinanced a 300 million bond with a new 500 million bond, so there's some cash left, and on top of that, with cash from the balance sheet. So no refinancing there. The next maturity is at the beginning in the first quarter of 2027, so around 12 months from now. There we plan to refinance that in the next couple of months. It's not finally decided yet with which product or mix of product, but you can expect to hear from us quite soon there in that regard. And look, having said that, it's also important to note that there is no refinancing risk. So the group has sufficient cash on the balance sheet and also sufficient available facilities under the RCF, which matures in 2030, to refinance the maturity of next year, even if we would not go into a new arrangement on the market. ROIC, Xavier has quickly announced it. ROIC is something which is extremely important for us when managing the business. It drives any decision when it comes to CapEx. It drives a decision when it comes to business development, be it organically or inorganically via M&A. So whenever we enter into a new project, we look at the ROIC. And we look at, obviously, when you look at single projects, at IRRs and at present value and some other performance indicators. Now, we haven't communicated that to the market in the past. We didn't want to distract from our KPIs, turnover growth, EBITDA margin improvement, and equity free cash flow. We will continue to report those, but nevertheless, we came to the conclusion, based on feedback also we got from the market, that it's important to show you also the ROIC. The ROIC for us follows a very strict definition. We believe that it's a very clean definition. We take into account everything, taxes, minorities, so everything which is related to the business and for our business model is included there. It's a very clean number from that perspective. And what is also important, and Xavier has mentioned it at the beginning, is the progression over time. So we see a strong improvement year on year, reaching 11.4% in 2025. And you see clear the trajectory here. It's reflected in the arrow. We do believe that it will improve over time going forward. And we will do everything and all the decisions we are continuing to do in 2026 and beyond with that in mind, and with having in mind that it should be accretive for the ROIC going forward. We are not going to report that number on a quarterly basis. It will be reported on an annual basis, so the next time you hear about that is in 1 year time. We will continue to report all the other KPIs in the usual fashion, but for that, I believe once a year is sufficient, and we will also report, obviously, last 12 months information in that regard. Moving on to the capital allocation policy, it's the same as we have shown for the last 2 years. There is no change in that regard, and I believe that's also important, and that's the key thing about it. We are using it very strictly. we have the clear priorities to reinvest into the group. We have just discussed CapEx before when talking about the cash flow. We will continue to do that because we believe there are opportunities out there which are worth exploring and to enter into. On top of that, we are looking or continue to look into some small to medium-sized bolt-on acquisition, fully cash financed and with the requirement to be accretive in general, but also from a ROIC perspective. And we are very much focused on maintaining the leverage and the leverage targets we have discussed before, between 1.5 and 2 times net debt to EBITDA. And last but not least, whatever is remaining as a free cash flow of the organization, we are using as a cash return to shareholders. We have discussed it before, but as a summary once more, the dividend, where we have started about 2 years ago to pay 70 cents per share as a dividend, improved significantly to 1 Swiss franc last year, and a further 15% improvement for this year proposed by the board to the General Assembly. We are following a very strict 1/3 of equity free cash flow there, and that leads basically to that pattern. On top of that, we have continued with the share buyback. We did a cancellation of treasury shares 2 years ago. We did the share buyback last year of 200 million, and we have announced this morning today a further program to be launched shortly for 225 million Swiss francs. And if you take all of that together, that's a reduction of around 10% of the shares since we started with cancelling shares and the share buybacks around 2 years ago. So a significant reduction in the number of shares over the years. And if you calculate all of that together, the dividend and the share buyback, that basically reflects a cash return to the shareholder over the last 2 years, including now 2026, of more than 1 billion Swiss francs. So a significant amount. That basically brings me to the end. As a quick statement before I hand over to Xavi, what is outstanding about the result from my perspective is threefold. First, that we have achieved this growth, disregarding some headwinds, and Xavi has mentioned them, we have faced during 2025, while at the same time improving profitability. That's point number one. Point number two, we have continued to invest into the organization by investing 500 million CapEx, while still significantly improving the equity free cash flow. And number three, we have achieved the target leverage of 2 times, while at the same time generating cash returns to the shareholders of a significant higher dividend and a 200 million equity free share buyback. Having said that, I hand over back to Xavi for the conclusion.
Thank you, Yves. Well, to avoid to be repetitive, good performance, all the KPIs in line or ahead of the outlook, very strict capital allocation, growth, deleverage, return to shareholders, an obsession on profitable growth, and we confirm the outlook. The last thing I want to say is first thank everybody here, thank the shareholders for the continuous support, particularly in the last few years, also the strategic shareholders, the board, the suppliers, the landlords. A lot of the things we are trying to do are only possible in the combination with the suppliers and the landlords, the three together. And the last and most important thanks to all the team members, starting from my colleagues at the Group Executive Committee, going through all the global function, all the regional functions, all the shops, all the restaurants, all the warehouses, everybody of the 75,000 employees of Avolta that, thanks to you, we are delivering these results. And a last word of solidarity with our employees in the Middle East. They are going to the shops, they are going to the restaurants, despite being in the middle of war. So we appreciate your support, we appreciate your commitment to the company. And I also want to thank the magnificent collaboration we have with the airport authorities and the authorities in that part of the world that have been tremendously supportive and also focusing a lot on the safety of our employees. So thank you very much. Now we are going to open for questions and answers. Thank you. Okay, so thank you very much for everybody attending this call. And remember, if you travel in Avolta shops or restaurants and become a Club Avolta member, you're going to get a bunch of benefits. Don't miss the opportunity. Thank you very much.
Thank you.